39 states do not tax Social Security. Do you plan to retire in one of the states that does tax it? You're going to want to know that. I've got that and more coming up. My name's Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. Taxation on Social Security feels like a ripoff, guys. I can get on a soapbox with this because here's the deal. You pay FICA tax, that four-letter F word, on your wages and self-employment income. And up to a certain amount, it's $160,000 this year, you pay the Social Security portion of FICA, 6.2% on your wages up to that limit of $160,000 or so. But that FICA tax that you pay, that's not a deduction. That's not a deduction. So you're paying that tax and not getting a tax deduction for it. Therefore, that 6.2% goes in the Social Security system, okay, with your name on it, with a little ribbon and, packaged just for you out there when you're 62 to 70. I'm just kidding. It goes, it's a Ponzi scheme, essentially. And so it goes into the Social Security system. And then when you retire and start drawing Social Security, you say, okay, start paying me some of that money that I was forced to contribute out of my paycheck, and they could tax it. Meaning, when you start drawing the Social Security money that you set aside with after-tax money, they could tax that money. It's double taxation, guys. And you could say, yeah, but how much you're paying in, the total amount that you're getting out. I understand, but they intentionally set up the laws where they don't do that calculation, where, well, you don't have to pay tax on the amount that you pull out, but you have to, or the amount that you contributed. It's just complicated, guys. Social Security started back in 1935. They started actually pulling that tax out in 37. The first monthly payments began in 1940. It's been around for a long time. It wasn't intended to be taxed. People, at least, way back when this country was founded on frustrations with the tax system, and that wasn't too long ago. That was still very much a part of the fabric of our country back, almost 100 years ago now. And now we've sort of forgotten. It was never supposed to be taxed because people were charged up, just like me, and they said, we're not taxing it. Well, in the early 80s, that's when they made an amendment and started taxing Social Security, but only up to half of it was able to be taxed. If your income was above a certain threshold, I'll show you those numbers in just a second, then up to half of your Social Security could land on your tax return. Okay, I don't love it, but it's not that painful. Well, then in 1990, they passed another amendment, and that added a second tier to that taxation. The first tier remained. If your income was above a certain threshold, then up to half of your Social Security could become taxable. But the second tier that they added in 1990 was if your income's above another threshold, then up to 85% of your Social Security could be taxable. And now, don't hear me. Most people do hear this incorrectly and say, the tax I'm going to have to pay on my Social Security is 85%. I'm going to have to pay 85% tax on my Social Security. Nope. It's 85% of your Social Security will land on your tax return. That's what you'll have to pay tax on. Not that's what your tax rate is. If you're in the 12% tax bracket, then you'll pay 12% federal tax on 85% of your Social Security benefit. Okay, so it's confusing. I've been communicating this and teaching this for 20 years. It hasn't gotten any easier. So that's how I feel about taxation of Social Security. I'm assuming how you feel as well. That is how Social Security was originally not meant to be taxed, and now how it currently is taxed. And to make matters worse, and we've done some talk shows on this before, those thresholds at which your Social Security becomes taxable, those have never increased with inflation. It has never increased with inflation. So essentially at the federal level, you take a look at all of your income, add all your income up, plus half of your Social Security. And if that number, that's how they're defining modified adjusted gross income for Social Security. So all of your income plus half of your Social Security. If you are single, then if that calculation is less than $25,000, you don't have to include Social Security, any Social Security on your tax return. Once that calculation is above $25,000 but less than $34,000, your Social Security starts becoming taxable up until half of your Social Security becomes taxable. And if that calculation is above $34,000, then more of your Social Security starts becoming taxable until 85% of it lands on your tax return. That's for single. Those numbers go to $32,000 if you're married filing jointly, and that's where some of your Social Security starts landing on your return, up to 50%. And then if your income, that calculation, all of your income plus half your Social Security is above $44,000, married filing jointly, then more of your Social Security starts landing on your return up until 85% of it. Guys, those are pretty small numbers. Those are small numbers, and they've never been indexed for inflation. That's at the federal level. Now let's talk about at the states, okay? At the state level, we've got 50 states plus the District of Columbus. Most of these states, 39 of the states, do not tax Social Security. And I don't know why. That's just part of who I am. I feel like that's fair. And you got to throw that F word out the window as well, because the tax system, it's just not fair. But 11 states actually do tax Social Security. Is this a video to bash those states or try and influence them? No, to each their own. And I'm assuming they've got other benefits. In fact, if I had a favorite state out there, one of my favorite states is on the list that actually tax Social Security. For those of you that are doing financial planning, specifically tax planning and tax planning for your retirement, you want to be aware, if you plan on relocating at or near retirement, is it possible you're going to relocate to a state that actually taxes Social Security where it wasn't before, and now you've got to be aware of this and maybe plan ahead for it. So here you have it. Connecticut taxes your Social Security benefit, or can. Okay, many of these are going to follow the federal levels, that if your adjusted gross income is below a certain level, then it's not going to be included. Some of them also, many of the states also have another threshold that if your total income is above, say, $75,000 single or $100,000 joint, then they're not going to tax it at the state level. So each state is a little bit different, but Connecticut, it's possible that it's taxed. Kansas, Minnesota, guys, I don't know. I don't know if you've ever been through Minnesota. It is beautiful. It is beautiful. And I'm from the Midwest. I've always lived in the Midwest, except a little bit in college, and Minnesota just stands out as one of the most beautiful states out there. I love all the four seasons. I love the lakes. I love the woods. It's just a beautiful, beautiful state. Minnesota could tax your Social Security. Missouri, Montana, also lots of folks will consider retiring to Montana or having some time in Montana. Nebraska, New Mexico, one of the, southern state, so some people consider retiring there. Rhode Island, Utah, Vermont, West Virginia. Those are the 11 states where your Social Security could be taxable at the state level. All right, so what do you do with this information? Again, it's not to poke any of these states in the eye or their legislature or make anyone feel bad. It's more for planning, okay, for planning. And listen, states change tax laws all the time, and that's why I shared how things have evolved with even at the, taxing Social Security at the federal level. Things change, okay? So this isn't to talk down about a certain state's tax structure, but it's more so for you to plan ahead. Not to avoid, but to plan ahead. If you live in one of these states, then you should be aware already how Social Security is going to be taxed at retirement and working with your financial advisor to project that out. For your 5-factor retirement plan, you know that one of the big factors that determines whether you're able to retire, when you're able to retire with confidence, and what the variables are, is how much are you going to spend. Well, taxes are part of that spend, and you need to be aware of and actually projecting out what's your tax picture going to look like? What's your tax spend going to be out there in retirement? So if you live in one of these 11 states, that's got to be part of your plan. But more importantly, if you don't live in one of these states, but you may retire to one of these states, it could come as a surprise that these states or that state might tax Social Security. Don't let it come as a surprise. Plan ahead, be aware, plan ahead, work with your CFP to figure out, well then, what will the tax be? How can I factor that into my plan? Does it move the needle at all or not on some of my variables and some of the decisions so that you can still retire with confidence? Work with your CFP on that. If you don't have a CFP on your team, you can contact one on my team. Find us online, Korhorn.com. That's Korhorn with K, wisemoneyshow.com. You can find us there as well, or send us an email, info@korhorn.com. All right, there you have it. Go out and take your next wise step in your financial life.